Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In Part 2, we'll cover advanced strategies to help you maximize your returns in DeFi protocols. Ready to take your investments to the next level? Let's go! Regulatory and compliance risks. Governments are still figuring out how to regulate DeFi. Some countries welcome it, while others ban crypto outright. This uncertainty can shake the market overnight. For example, strict regions. China and Nigeria have cracked down on crypto activities, making DeFi access difficult. Tax reporting. The IRS and EU now require crypto tax disclosures. If you earn yield, you could owe capital gains. How to stay safe. Keep an eye on news from major markets. Rule changes often hit token prices. Use privacy tools wisely. Mixers or offshore accounts might invite scrutiny. Report earnings legally. Tools like Coinly or CoinTracker simplify tax filing. Regulations aren't always bad. Clear rules can boost adoption. But until then, assume every policy shift could impact your portfolio. Market volatility and liquidity risks. DeFi markets move fast. A token can surge 50% in a day, then crash when whales cash out. Liquidity, how easily you can trade without huge price swings, varies wildly. For example, low liquidity pools mean bigger slippage. A sudden market downturn can lock your funds in underwater loans or force liquidations. Strategies to manage risk. Diversify across high TV projects. Uniswap or Curve usually have deeper liquidity. Avoid farm and dump tokens with no real use case. Stick to protocols with steady user demand. Use stop-loss tools on centralized exchanges if you're actively trading DeFi tokens. Pro tip. If a pool's APY seems too good to be true, check liquidity depth first. High rewards often mean higher risk. Smart contract exploits and impermanent loss. Code is law until it's hacked. Even audited protocols get drained. Meanwhile, impermanent loss hits liquidity providers when token prices shift. Key risks. Impermanent loss worsens with volatile pairs. Providing ETH or stablecoin liquidity is safer than meme coins. Flash loans let attackers manipulate prices. Protocols with robust circuit breakers handle this better. Mitigation tips. Split funds across multiple protocols. Never put everything in one pool. Pick stable or correlated pairs to minimize impermanent loss. Monitor DeFi Safety or rugdoc.io for exploit warnings before depositing. Remember, DeFi isn't a casino, but it's not a savings account either. Treat it like a high-stakes startup investment. Research deeply, expect turbulence, and never risk more than you can lose. Strategies for successful DeFi investing. DeFi investing isn't just about chasing high APYs. It's about smart tactics to balance risk and reward. The right approach can turn volatile markets into opportunities while keeping losses manageable. Here's how to invest with confidence. Diversifying across multiple protocols. Putting all your funds into one protocol is like betting everything on a single stock. Spread your investments to reduce risk and tap into different income streams. A balanced DeFi portfolio might include lending protocols. Earn interest on stablecoins with lower volatility. DEX. Provide liquidity for trading pairs, favoring stable or correlated assets. Yield aggregators. Automate yield optimization across protocols. Insurance. Hedge against smart contract failures. Allocate based on risk tolerance. For example, low risk. Lending stable swap liquidity, governance tokens. Moderate risk. Liquidity pools, leveraged yield farming, staking. Diversification won't eliminate losses, but it smooths out the bumps when one sector dips. Staying informed about market trends. DeFi moves fast. New protocols launch daily, and regulations shift overnight. Stay updated with these tools. Newsletters. Bankless or the Defiant. Analytics platforms. DeFi Alama, Dune Analytics. Communities. Discord groups or subreddits like r/DeFi. Set up Google Alerts for key terms. Follow developers on Twitter. They often hint at changes before announcements. Bookmark these resources. DeFi Prime. Etherscan. Rugdoc.io. Knowledge isn't just power, it's profit. Spotting trends early lets you adjust before the crowd. Ready to refine your strategy. Start small, track results, and scale what works. The best investors adapt faster than the market moves. Future outlook of DeFi investment. The DeFi space is maturing, and its future hinges on two critical shifts: bigger players stepping in and technology solving its current limits. While retail investors drove early growth, the next phase could see deeper liquidity, better infrastructure, and broader adoption. Here's what's coming and why it matters for your investments. The role of institutional investors. Institutions are slowly warming up to DeFi. Hedge funds, asset managers, and even banks are exploring ways to participate without exposing themselves to undue risk. Their entry could bring stability and higher stakes. Why this matters. Liquidity boost. More capital means tighter spreads and lower slippage for everyone. Regulatory clarity. Institutions won't dive in until rules are clearer. Their involvement could push governments to define DeFi's legal standing faster. Product innovation. Expect more institutional-friendly tools like compliant yield products or insured custody solutions. But there's a catch. Big players often prefer permission systems over pure decentralization. Some protocols might adapt to meet their needs, potentially drifting from DeFi's original ethos. Innovations on the horizon. Scalability and high fees remain DeFi's biggest hurdles. The next wave of tech aims to solve these without sacrificing security. Key developments to watch. Layer 2 solutions. Protocols like Optimism and Arbitrum cut Ethereum gas fees by processing transactions off-chain. Cross-chain bridges. Projects like Cosmos and Polkadot let assets move seamlessly between blockchains. Zero-knowledge proofs. Tech like ZK rollups enhances privacy while keeping costs low. These upgrades aren't just technical, they're economic. Faster transactions mean more efficient markets, and cross-chain interoperability opens doors to global liquidity. For investors, that translates to better opportunities with fewer bottlenecks. The future isn't just about higher yields. It's about building a system that works for everyone, from casual users to Wall Street. The winners will be those who adapt early, without forgetting why DeFi started in the first place. DeFi protocols offer a fresh way to earn higher returns by cutting out middlemen, but they're not a shortcut to easy money. The best opportunities come to those who understand liquidity pools, smart contract risks, and market volatility. Research is non-negotiable. Audits, tokenomics, and community health separate sustainable projects from flash-in-the-pan schemes. Risk management keeps you in the game. Diversify across trusted protocols, stay ahead of trends, and never invest more than you can afford to lose. The DeFi space is evolving fast, with institutional interest and tech upgrades shaping its future. Ready to explore? Start small, keep learning, and move with caution. The smartest investors don't chase hype, they build knowledge first. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.